Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 73 of Carson's... What's this called, Sonu? I got it too early. Facts versus Feelings.
Facts versus
Feelings.
Feelings.
We do different videos, and I've had to pause there for a second. But here's my excuse. I was on CNBC 5 hours ago. Okay, it is like
right.
10 in the morning Eastern time, everybody. So it was an early morning. I had a little pause there, but we'll leave it. That was kind of funny. So we got a lot to discuss. We're going to title this one, Did the Economy Actually Slow Down? Because we saw some data last week that said it slowed down a little bit. We're going to dive in. But before we go there, is it true you bought a mattress yesterday on President's Day? Did you get suckered into the greatest deal ever?
Between mattresses and whatnot, everything else, right? Stuff I don't really need for the home. No, I didn't. No.
Yeah.
I've always been, it's been, ever since I came here, it's the whole sale thing, right? Every holiday is such a magnet for, and I don't mean this in a bad way, consumerism, right? Oh yeah, like it's a holiday, spend money, right? But that gets to a lot of what we talk about. I mean, people have money to spend and, times are not too bad.
You're right. I mean, I remember as a kid, President's Day, it's like, okay, there it was. Now it's turned into this really big deal. Like my kids had Friday off. They had Monday off. Lots of people do vacations, lots of mini little vacations around President's Day. It's like, oh, well, it's an opportunity to get out and do some things. What did you do
with the kids? Oh, okay.
You go first. Okay. Yeah.
So I had the day off. My wife didn't, so I was with the kids. So my kids had the day off too. We actually... they started the morning on their iPads, which I was like, okay, this is too much, right? We were all suckered into getting on our screens. I was like, okay, we're going to go out. And to incentivize my kids, I said, let's go out to this diner we like. And they get crepes with Nutella and bananas in it. So obviously you can't go wrong. And then we spent a couple of hours by the lake. It was a really beautiful day here in Chicago. So that was nice and got some exercise.
Well,
what about you?
Yeah, we had a bunch of basketball games. Basketball's ending, so we had a bunch of basketball games. I did nothing out of the ordinary, I don't think. But it was a good weekend. So, but we're back. I mean, like I said, I don't even know what the name of our podcast is. Only done 73 of them. You said he didn't even look at anything yesterday. So we'll see how this goes. We'll see. Yes. Sonu goes, what happened last week? I said, I don't know. We'll come up with something. Now we'll welcome everyone to episode 73 of Facts versus Feelings. And again, we're titling it, Did the Economy Just Slow Down? We're going to focus on three things today. We're going to take a look at the stock market in general, like we tend to usually do. And then we're also going to take a look at inflation, saw some hot inflation data, and then finishing it again with some of the economic data we saw last week that, at least on the surface, looked a little weak. So, Sonu, what I want to start with, though, is on the market. Markets finally had a down week. Remember we talked last week, S&P up 14. 14 out of 15 weeks, up 22% during that 15-week streak. So we said, listen, you might have a little consolidation, a little downward action. That's perfectly normal. But here's what I ask you, Sonu, because if you look at it, it was kind of the Mag 7. The technology didn't do as well that pulled the market down. But then you peel back that onion, and we actually saw small caps and mid caps were higher last week in the midst of what we're going to talk about throughout this conversation, but just high level, hey, inflation was higher, yields went higher, and expectations of rate cuts went lower, yet small and mid did well. You want to talk about some of those things?
Yeah, I'm just looking at my daily note that I do for advisors from Friday. And, I label it like, I'm looking back now, market's not a bad week. And the irony was the S&P 500 was down for the week. The Dow was down for the week. The NASDAQ was down for the week. But why was it positive? Like, in my view, it was positive because, to your point exactly, rate cut expectations fell, right? As to how fast the timing of the first interest rate cut by the Fed and the number of cuts in 2024, right? All of that fell. We'll talk about the inflation data and all of that. But at the same time, small caps did well. Cyclical sectors like financials and industrials outperformed. These are not areas you expect to outperform when rate cut expectations are going the wrong way, right? I mean, so I thought it was a very positive week, Ryan. What about you?
Yeah, I can't disagree. I mean, you've got financials, industrials, both flirting with all-time highs last week, especially on a weekly close. Transports as well, and that's not typically the hallmark of a market that's about to just roll over and fall into a recession. To see that leadership. Also, we
just one thing on that.
Yeah, go ahead.
As technical guys, you guys like transports a lot, right?
Yeah, I mean, yeah.
Like there's a route transport thing, and
transports
being a
matter.
positive indicator.
Yeah, you look at the industrials and transports. It's been a long time ago. Charlie Dow created this called Dow theory, and it's, I'm no expert on it, know enough to be dangerous. But, if one makes a new high, let's say industrials makes a new high, but transports doesn't confirm, that's a warning sign, and vice versa. Sometimes at bottoms, like major market lows, you'll see maybe industrials make a new low, but the transports don't confirm it. That's a positive divergence. So again, all in all, I mean, I'm not seeing any major. Now, here's something we've actually talked in this podcast about this, like transports matter. I'm not naive to that, but maybe semiconductors are the new part of our economy. So like what is semiconductors doing as well? But also, so I was talking about things making new highs. Also, the S&P 500's advanced decline line, a cumulative basis, how many stocks going up versus down in the S&P 500, that hit an all-time high last week. So listen, we could be due for a well-deserved break. We've talked about that the last couple of weeks, and we kind of maybe started to see that last week. But there's really a lot of strength that tells me I don't think it's going to be like a 10% pullback or a 15%. Or, one more thing on this, and just love your comments. I just, working over the weekend a lot to get caught up on some things yesterday. So you didn't work. I got caught up on a lot. At least
one of us did.
That's all right, But I knew this, but it's kind of good to remind myself. So last year in February and into the middle of March, we had the regional bank crisis. S&P pulled back 7.8%. From the end of July, literally the day you and I had bullhorns on with Tom Lee, I said, that's got to be a signal. Yes. When Tom Lee he didn't wear bullhorns, you and I did, but we had Tom on. Yes, that was the end of that great start to the year. Then we had a 10.2% correction into October 27th, and then off to the races. What I'm getting at, stocks gained like 25% last year. Yeah, we had about an 8% correction or pullback and a 10% correction. And both times led to incredible amounts of fear. So I guess the answer, or the thing I'm trying to say is, every year, if it's a good year, not every year, but most years, if it's a good year, probably has some scary moments. You think that's probably true?
No, absolutely. It goes back to, in my mind, I think you've told our advisors print it out, but it's literally sort of printed in my brain. The chart you have of how many corrections, how many pullback, like if you think about a pullback, like 5% pullback, 10% correction, 20% bear market, right? And how many of those happen a year? Like you get 3 corrections a year, something like that. You get, 1 or 2 or 3 pullbacks or thereabouts a year, 1 or 2 corrections a year of 10%, and so, this is par for the course. Volatility is, to your point, something you've said before, volatility is the toll you pay to invest. And
well, absolutely. I've Ben Carlson, over at Animal Spirits and Ritholtz, he wrote a blog recently, just talked about how we've had 2 bear markets recently, right? I mean, 2020, last I checked, 2020 had a bear market, and 2022. He's like, listen, never in history, and believe me, records are meant to be broken, we get it, but never in history we had like 3 bear markets within a 5-year period. So if someone's looking for the next bear market, not saying it couldn't happen, but when you look at it, we have had 2 bear markets recently. To a third this soon? Probably not. And if you listen to us for a while, that's definitely not the case, we think. Now, it was Valentine's Day. I've got the Valentine's Day indicator, but what did you do for Valentine's Day last week before we go there?
I traveled. I was traveling to Los Angeles.
There you go.
No, on the day before Valentine's Day, I was like, so I after school, I pick my kids up, and sometimes it's by car, but it's only a 2-minute drive from where I am. I was like trying to incentivize them into doing something other than coming back home and just lying on the couch or whatever it is. I was like, let's go to the store and pick out flowers for mom, right? And so that turned into a whole thing because all 3 of us, I have the 7-year-old twins, all 3 of us had different ideas of what flowers to get for mom / my wife. So she ended up getting 3 bouquets, a chocolate cake, which was mostly for us, but still, that's what we did on the day before Valentine's Day, February 13th. What about you?
Yeah, you said chocolate cake. You didn't go to Gibson's by chance, did you? And get her one of those? You did? Yeah.
I'm saving that for the next time you come
oh
here.
My goodness. Yeah. I guess it was November. I was up in Sonu's neck of the woods in Chicago, into that Gibson's up. Was it Roselawn? Is that
area? Rosemont.
My apologies, Rosemont. Yeah. But yeah, it's just, you say, oh, give me a piece of chocolate cake. It is, it'll feed 9 people. It's crazy. Anyway, what was I talking about? Oh, Valentine's Day. Yeah, we didn't do too much. Actually, it was kind of fun. I took my wife to lunch on Valentine's Day because, we had practice and different things in the evenings. That was kind of nice. And then Gus, my youngest son, he had a Valentine's Day party. He's only in 5th grade, and I kind of had the afternoon off. So we're not off, I had a little free time in the afternoon. So I snuck over to school for an hour and a half and was like a chaperone. Now, believe me, I'm not the best chaperone. I just kind of try to help, let the moms do what they're doing, and I just kind of am there. But that was fun because it's funny because, like my daughter's 16, my other one's 7th grade. Like, we're not doing that stuff with them anymore. I was like, ooh, I wanted to take an opportunity to do that. So anyway, so let's talk about the Valentine's Day indicator. So as of Valentine's Day this year, Sonu, the S&P was up over 4%, like actually up over 5%, I believe. But I took a look back to 1950. 28 other times the S&P was up at least 4% on the day of red, the day of hearts, the day of love, Valentine's Day. I joked it should be called the green indicator.
Day of hearts, day of red.
There you go. Well, I'm going somewhere with this. I've got green on my mind where I'm going with it. The Valentine's Day indicator is flashing green because the rest of the year, so I'm not talking the full year, I'm talking the rest of the year, starting on Valentine's Day, the rest of the year, S&P has been higher 26 out of 28 of these previous times, up 13.3% on average. Your average year from Valentine's Day to end of the year gains about 7.5% and is higher about 3 out of 4 times. Again, this one indicator, I get it. But when you start stacking all these on top of each other like we have been, if there's any seasonal near-term weakness, boy, oh boy, the Valentine's Day indicator says look for higher prices. You want to add anything there?
No, I think again, it gets to momentum, right? You want momentum in markets. At the same time, you don't want a stretched rubber band, so to speak, right?
Mm-hmm. Yeah.
At the same, you don't want a broken rubber band either, right? I mean, the rubber band
that hurts. Yeah.
You don't want a broken. So, if anything, I'd rather a rubber band that's intact and that's in the process stretching. Maybe not at its peak moment of stretch, but yeah, no, it's momentum is a good thing. I mean, given all else equal, I'd rather markets be up, right? Which based on your data, that's what we're looking at. I'd rather markets be up through the middle of February than down.
Yeah, no, exactly. And that's where we are. And even on the heels last year of obviously a really strong year. So you could say, well, maybe you give back a little bit. And there's pockets that have given some back. Small caps and mid caps, they've started to take some of that leadership back, like we said. Well, Sonu, I mean, we've got more to discuss. Inflation and then the economy. Anything else you want to talk about from the stock market point of view before we go forward?
I was looking at your blog. I mean, in the process of reading a blog for today. So this is Ryan's blog will be out on Tuesday. Okay. What's today's date? February 20th, right?
No one knows. No one knows what day it is. No one knows. I got up at 4 o'clock in the morning. I don't even know what my podcast is called. It's one of those days. Yeah.
So you brought up, I mean, you put the Valentine's Day indicator. I mean, there's momentum in markets, which is a good thing. Talk about sentiment, because you had a nice chart about sentiment is going up, but it's not, speaking of things that are stretched, things are, investors are getting more optimistic. They're not wildly optimistic, right?
Yeah, as well. Good way to put it, because again, I mean, there is some optimism starting to creep in. You look at various sentiment polls, and these are just sentiment polls. How do you feel? People are feeling more optimistic. I love to use the Bank of America it's just Bank of America Global Fund Manager Survey. It comes out once a month, right around the middle of the month. And this one's nice because it's like, at least it used to be $600 billion. It might be even more because the stock market's higher, but it's people that manage real money, how they're feeling. And they've got different ways they slice and dice everything, but just their overall view was we're at 2-year highs in optimism. Okay, 2-year highs in optimism of the Global Fund Manager Survey. But then you look, and that's like, oh, that's okay. Well, that's interesting from a contrarian point of view. But then you look at the bigger picture. We're nowhere near some of the major peaks. It just tells you how dour things were this time 12 months ago. So, and again, why do we call our outlook, which we released well over a month ago now, eye to eye, seeing eye to eye? Because we said last year no one saw eye to eye with us because we were talking about no recession, strong stock market. Now people are starting to see more eye to eye, and that listen, we're in a bull market. We think stocks are going to do pretty well. Just this week, I mean, Goldman and some other big shops just, again, increase their guidance. And guidance was the word I'm looking for. Their targets on the S&P 500. And we're seeing that. But the one that really got me, Sonu, again, in this survey was the whole hard landing, no landing, soft landing. There is an enormous jump in the number of people in this global fund manager survey looking for no landing. Something you were saying a year ago when you said the plane has plenty of, how did you say, the plane has plenty of gas. There's no need to even land. Yeah. I mean, you want to talk about that. So again, I'm not saying this is the end of the world type of stuff at all. We don't think that at all. But just now, a year ago when we were bullish, people hated it. People were mad at us. People were so angry, just angry to point out positives. Now we're seeing people agreeing with us. And as a guy who's done this for a while, I'm like, okay, doesn't mean the market can't keep going up. We think it will, but maybe those easy gains that we had last year when no one believed us, those are gone, right? What do you want to talk about there on the hard landing survey part?
No, I think we've brought this up maybe a couple of podcasts ago when you talk about, I think the landing analogy works better if you're talking about like the Dukes of Hazzard type landing.
Yeah.
with the car jumping over the ravine. And then, when you land, obviously you don't want to hit the cliff on the other side, but we didn't do that. And then when you land, you don't want to hit the brakes because you just topple over. We didn't. And now we're churning along the road. And it doesn't mean there could be other obstacles on the way. There's always obstacles on the way, right? We're going to talk about that. I mean, just this morning, I saw a piece saying Larry Summers, of all the people, Larry Summers gets, I think, more coverage than but he's a great economist for what it's worth. Right? Sometimes maybe I have my own issues with that. But he's like, Larry Summers predicts there's a 15% probability of the Fed increasing rates this year. I'm like, wait a minute. And the headline's like meant to be scary, right? Oh my God, everyone's talking about rate cuts, and here the preeminent economist of our time, Larry Summers, is saying we could see rate increases. But then I'm like, wait, 15% probability. That's a 15% probability that anything could happen in markets in any year, right? That's a completely meaningless probability, right? Like there's a 15% chance of a recession. In fact, I would say there's any given year, right? So I'm like, Larry Summers is not telling anything. And look, this is the guy who said, I mean, not to pick on him, but I will. Why not? And this is the guy who said, we need mass unemployment. We need 6% unemployment for years for inflation to come down. We are at 3.7% unemployment rate. Inflation's come down. Yes, we're going to talk about the little number that went up in January, but I think that's idiosyncratic. That is weird January effects and all that written all over it. But still, like, I think there's no better way for the hard data to prove somebody wrong than what just happened.
Yeah, and I don't believe Claudia Somm is going to send him a Christmas card or holiday card this coming year. So Claudia, a friend of the show, been on the show. She and Larry have been going at it for a while. And Claudia is quick to let him know that, scoreboard. Anyway, enough about that. Good stuff there. So Sonu, let's move forward. We are going to talk about inflation next, but I know you just had, I guess we'll call it an anniversary, a very, very special anniversry, one we wanted to talk about. You want to, I didn't. See, like I told you, one of us did some work over the weekend, wrote this stuff down, what we're going to talk about. Go ahead. You just take it away. What did you do? Was it 10 years ago?
10 years ago.
10 years ago. Take it away.
10 years ago, February 18th is when I had my U.S. citizenship naturalization ceremony. And I have to tell you, like, I get goosebumps thinking about it. It was like, I'd been in the U.S. for 14 years up to that point. So this is in 2014. I came here in 2002 to aerospace at Purdue. And, here's where I am right now. But that ceremony was, if ever anyone listening, or even yourself, Ryan, if you get a chance to go to one of these oath ceremonies, right, it is amazing. There's so many people from all walks of life, right? Rich and poor, like everyone's just equal. And that's, I think, the story of America right there. Like everyone's on the same footing and, everyone's taking that oath and everybody is happy. Yeah. Right. I mean, the only other place where everyone's happy all the time is probably Disneyland. But,
even then, that's expensive. I don't know. Sometimes maybe not. Yeah.
But no, this is like, I think a part of it is everyone feels like, oh my God, I made it. Right. Like me as a little kid, I was looking up at, you and I talk about movies, that my favorite movie is Rocky. Growing up with like you talk about American culture outside the U.S., right? What is it? I mean, our biggest exports. I mean, you talk about aircrafts and things like that. And it was NASA and it was Hollywood movies and Sylvester Stallone and Schwarzenegger and all of that. You grew up and like, wait a minute, I want to be part of that. I want to make it to America. And then, all that sort of came to bear on, February 18, 2014. And so that was a really cool experience. And 10-year anniversary being a U.S. citizen.
Well, congratulations there. That's awesome. Obviously, listeners are glad you're here. And, if you still lived I mean, I should know that you you were born in India, but you were raised in the Middle East, correct?
Yeah. And
get real in the weeds on Sonu's life here. Yeah.
Grew up in, I was born in India, but within 3 weeks, I think my mom took me. My parents were travel agents in the Middle East in a country called Oman. So it's right on the Persian Gulf. So if you have any questions about the Persian Gulf, I know that area pretty well. I mean, right on the Arabian Sea in a city called Muscat. But then I went to boarding school at the age of 9 through 17. I was in boarding school in India. And then I came to Purdue and, for master's, PhD, whatnot. And here I am with you today.
Got it. The rest is history. Well, that's awesome.
That's the American dream. I'm living the American dream.
No, that's great. No, it's awesome. It's so neat that you got a chance to share that story, I think, with the listeners, just to connect a little bit more with Sonu Varghese, our VP, Global Macro Strategist.
Don't forget the VP.
I know. All right, so let's just go forward here. Great stuff there. Inflation, right? I know last Tuesday when you and I recorded this, and of course, most people might have listened to this on Wednesday or Thursday last week, we gently touched on CPI because it just came out, but we're going to dive more in now. But it was hotter than expected. We saw a massive sell-off in equities. I think the second worst day of the year for the S&P. I think it was the worst day for the Dow. The small caps are down like over 4%, at least the Russell too. This was on last Tuesday. Then we bounced back a little bit for the markets in general. Then Friday, PPI, the producer level, so CPI is consumer level, producer level, came in hotter than expected. So, I mean, listen, I don't know how you want to break it up or talk about both together, but the truth is we did see hotter inflation data last week. We saw yield spike and expectations of a March rate cuts like nowhere happening now. And even May is like, I don't know, on life support. What do you want to talk about there?
I think that's a good way to put it. May expectation of life support. All I'd say is, look, there's a lot more data to come out. There's at least 2 more inflation reports, PPI, CPI, personal consumption expenditures index, which is the Fed's preferred metric. But one thing I want to mention, look at the big picture, right? Here's a big picture. A year ago, January 2023, inflation, CPI inflation, which is what a lot of people, the media focuses on that. And with good reason, because that's historically been what everyone looks at. A year ago, it was at 6.4%. In June of 2022, it was 9%.
Yeah.
Right, CPI. This year, January, it hit 3.1% year-over-year inflation. So we made a ton of progress. It made a lot of progress in 18 months, right? From 9% all the way down to 3.1%. Now they say, okay, that's year-over-year. Let's look at the recent pace. Now, January picked up, but again, you average the last 3 months. Headline CPI inflation is running at 2.8%, right? So it's like, wait a minute, that's a little too hot, right? And then you think, I mean, you and I talked about this briefly. A lot of that is because shelter inflation is running hot. Shelter makes up 33% of the entire CPI basket, and it makes up about 44% of core CPI once you take our food and energy, right? If you take shelter out, headline CPI over the last 3 months is running at 1.1% annualized. Instead of 2.8%, it falls to 1.1%. So you can see what a big impact shelter is having. Now, it would be one thing if shelter made sense, right? Official shelter data makes sense, but it doesn't. It's like they're trying to get an estimate of me and you as homeowners, what would we rent to ourselves at? And they're looking at prevailing market rents, which is fine. Okay. But then prevailing market rents are telling one story. Prevailing market rents are down year over year, whereas official data shows it increasing at a pace of 6 to 7% annualized pace, which makes no sense, right? And that's basically what happened at January CPI data. I'll take a breather here, Ryan.
Yeah, no, there's a lot there. But again, we've been saying for a while, you look at the private data, Zillow, apartment list, I believe it's apartment list year over year is negative on rents now, 8 months in a row, yet the government's data is saying rents are significantly higher. We've been thinking that that's going to come back down soon. Maybe you could say it's been sticky. It hasn't. But I think a lot of the reason the market sold off on Tuesday was, oh my goodness, this inflation's out of control. Then Wednesday, Thursday saw a really nice rally.
It's like everyone looked under the hood, right?
Yes, exactly. And I know, we get a little geeky with this, but just amuse us because I think it's really fascinating. Sonu does a daily note for our partners. The OER is the owner equivalent rent. If you look at core CPI, it makes up about 34%. About 10% is rent. So that's about the 44% or so of of overall core CPI, again, is shelter. But Sonu, what you pointed out, if you looked at the annualized rate, and I've got it here somewhere, maybe you know it off the top of your head.
6.97%, something like that
Yeah.
last month.
Oh, man, I've got it somewhere, but I can't seem to find it. I've got so much. Oh, here it is. Boom. There it is. There it is. If you look at rents annualized, and again, last month it was 4.2%. That's the lowest in September 21. Remember, that makes up about 10%. Okay, of core
and
inflation.
That's actual rents. People renting.
People
actually renting. Yeah.
But the OER is how much we would charge ourselves, and it's kind of fluky to begin with. That was 6.9%, the highest since April of 2023. And remember, that's one of the largest divergences we've ever seen. These normally kind of go together. That's a huge divergence between what the rents are saying and the OER. We think the rents are the data we should be looking at, paying attention to. The OER, for whatever reason, is just still not kind of what we would expect, and we expect that to come lower. Sonu, did I do an okay job describing that while you caught your breath there?
That was fantastic. I'm not going to say any more. I think you nailed it.
Yeah. Well, okay. So that's that. Let's talk about PPI then. So that's the consumer level. Right. Let's talk about PPI. Again, that came in, I've got the numbers here somewhere, but that came in hotter than expected as well. Here it is. 0.3% in January. That versus expected up 0.1. Year over year is now positive 0.9%. Services was hot. Goods was down a little bit. Still, just the headline was hotter than expected. What do you want to talk about on the producer level of inflation here?
So let's talk about inflation metrics here, right? There's CPI, the Consumer Price Index, which measures in some way, including shelter, how much consumers are paying for goods and services. Right. Then there's PPI, the Producer Price Index, which measures what businesses pay for goods to buy from other businesses, because that's what they. There's also the PCE index, which is the Personal Consumption Expenditures Index. That's the Fed's preferred metric. They started using it, focusing, I should say, more on that in 2000 because it's more comprehensive in terms of the categories. It can be revised as well, and even things like shelter. Shelter makes up. We just talked about in. The CPI basket, it's about a third, a little more. Core CPI is 44%, right? But in PCE inflation, it's just about 15%. So it's a little more realistic, I think. And the Fed prefers that for any number of reasons, including the ones I mentioned. Now, PCE is also what consumers pay for goods, but it's measured from the business's perspective. How much businesses are charging consumers. So that's the difference between CPI versus PCE in terms of measurement, right? And then you get, why is PPI important? Yes, it's important because it measures how much businesses are paying for the goods they buy from other businesses. But a lot of components, inputs into PCE, the Fed's preferred metric, come from PPI. That's right now. Like, how many times did you ever think about PPI before the pandemic?
No, not very often.
I look at this often, and I didn't, right? Not as much. But now you're focusing it, and mostly because, like I said, a lot of components feed into PCE, all right? And that gets to several indicators within PPI that's relevant for PCE came in hard, and two particularly, right? Portfolio management services. It's not explicitly in CPI, but it's in PCE. And that's basically, it went up 5.5% month over month. Why did it go up? Well, stock prices are higher. So financial advisors, I should say people like us, are charging more because asset prices went up, right? So by itself, that's going to add a little bit to January PCE inflation. Then medical care services. So medical care services actually make up a bigger piece of PCE than it does for CPI. And the measurement is completely off. I won't even get into how it's measured in CPI. It makes no sense. It makes more sense for PCE. That jumped up as well, but it has to do with how the government pays out doctors in Medicaid and Medicare and all of that. There's a lot of January price effects. New contracts happen in January. So there's always, the government tries to seasonally adjust this, but it's never perfect. So we get these, it's not artificial, but it's like these one-off price increases that happen in January that go away in Feb and March, right? All that to say, January PCE inflation, which is what the Fed looks at, is going to come in hot, but it's going to be, I think, one-off rather than something that sustains into February and March.
Good points there. I mean, I shared this chart on, I guess it'd be Twitter last year probably, and I shared it on X this year. I guess we call it X. We called it Twitter a year ago. But it is hospital. Let me make sure. Hospital outpatient care. And care and services, and it was up 2.2% month over month this January. And you just take a look. every January you get this huge surge, and all the other times you don't get so much of a surge. So, should we really be that surprised? I know it's supposed to be seasonally adjusted, this and that. The government says, well, we don't really see a trend there, but I look at it, I see big surges every January, which kind of makes sense. So let's just put a bow on this and then talk about the economy. The bottom line, Sonu, is what from inflation? We saw higher numbers. So what's the takeaway for the listeners?
So when we get PC inflation next week, what we are probably going to see in all likelihood over the last 3 months, core PCE inflation, so excluding food and energy, last 3 months, is going to run at a 2.5% annualized pace.
Okay.
That's harder than we would like, than the Fed would like. But, a year ago, it was running about 5%, right? So we made a lot of progress. And then it's like, wait a minute, the Fed's not going to increase rates. Inflation's down, right? Let's be clear, right? Unless we get something, a big black swan or something that sends energy prices up for a reason that I cannot think about right now, which is why it would be a black swan, I think. I mean, not to. Other than that, I think inflation's made a lot of progress. It's on a downward trend, but there are going to be bumps along the way. And I think it does push out, the timing of Fed rate cuts, right? Instead of, we were never in the camp that the Fed would cut in March. Right. May, I think I was still 60, 70%. I still think there's maybe a 60, 70% chance of a May rate cut, because once we get data in February and March, I think, it'll continue to show that inflation downward trend story.
Yeah, I think it was Goolsbee, right? Chicago Fed in Chicago. He's a non-voting member.
Yeah.
Is it Goolsbee?
Goolsbee. Austin Goolsbee. Yeah.
Yeah, and he had a really interesting take on the yield curve a week or two ago. You can find it. Just talking. I won't even get into it, but just saying, listen, the inverted yield curve. Maybe it is different this time because it's not so much demand driven, but we do more supply shock. We don't need to get into that. But he on, I believe it was Wednesday, he kind of calmed some fears also about inflation. Say, listen, inflation. What you said. Inflation's come back a lot. It's not just going to be a perfect straight line. We've hit a little bump here in January, so to speak, but maybe we shouldn't have been so surprised when you peel back that onion and look at it a little closer. But nonetheless, the interesting takeaway from Goolsbee there, if you want to look that up. But I do, before we go, I want to read something from Bert White. Okay. What's Bert's exact title? Bert's Chief Strategy Officer at Carson about President's Day. So just give me a second here, Sonu. This is neat. He did tweet this on LinkedIn and Twitter. We often think of our founding fathers as being wise old sages. Go to the Smithsonian, and all the priceless oil paintings that capture this amazing history depict white-haired men with awkward teeth and weathered skin, dressed in three-piece suits in dimly lit, colonial architectured rooms. The paintings themselves are ancient and give the illusion that the subjects within were ancient as well. They were not. To put into 2024's generational terms, the signers of the Declaration of Independence would have looked like this. This is according to Bert's data. According to Bert. Millennials, 27 signers. Gen X, 20 signers. The Boomers, 9. Not a single silent generation signer. Again, Bert, and then a little bit more, Bert points out Thomas Jefferson was 33 years old in 1776. Ben Franklin was the oldest one. Oh, where was it? Bert wrote a lot here.
And he was a Gen Xer, or would he was in today's
he was like a Gen X. I mean, and Bert, he's a lot more, but I think it's just really interesting to think about things from that point of view. And then Bert does point out, listen, if you get over 10 years old, you usually lived into your 60s anyway. I mean, people think, people don't live as long, and that is true because there's a wildly higher, infant mortality, unfortunately, infant mortality rate back 250 years ago. But once you got to a certain age, you lived a pretty long and fairly normal life. But again, just to think about that a lot of young people actually shaped this country, even though they looked a little older in those old oil paintings that we saw. So
that's some perspective on experience. When you say, experience is so important, well, I'm not denying the importance of experience, but there's something to be said for, new thinking and young people and all of that.
Exactly.
To the table.
Yeah, think a different way, think a new way. It can get you in trouble too. Let's be very clear. But at the same time, to have a little bit of different views there is obviously the way to go. All right, Sonu. So let's try and wrap this up here. The final point is on the economy, and what we want to talk about: retail sales and industrial production. Just high level, both of them came in quote unquote weaker than expected. I guess let's start with retail sales if you want.
They were both disappointing. I mean, retail sales fell 0.8%.
Right.
January,
Expected
right?
to be down 0.1, according to at least what I'm seeing. And the control group was down 0.45, the lowest since March of 23, and expect to be up 0.3. Because we have talked before, the control group's been fairly strong. So take it away from there.
Right. So when you talk headline, 0.8% drop in January, I'm looking at my notes. Half of that we kind of already knew would happen. Auto sales had pulled back after a strong December. Auto sales pulled back in January. And then gas station prices also. Gas station sales fell. Why? Because gas prices fell, right? So that accounted for half that 0.8% drop. And then you think about what else fell: building materials, garden equipment, supply stores, right? I think that was because of, when the survey, all of this, when the data collection happens, it was during that really cold week in January, right?
Yep.
And so that fell 4.1%. That's what pulled the control group down. Why is the control group important? It takes out the more volatile pieces, things like auto sales, gas station sales, tobacco, all of that. It's what goes into GDP, basically. That's one good way to think about control group, right? That was down 0.4%. But over the last 3 months, the control group is up 1.4%, right? So there's still some momentum there. And for me, actually, what was a surprise, not to think of my, it may sound like, oh, he's always just picking the positive story, but I think this counts. What surprised me was actually restaurant and bar sales. If you told me, okay, January is a very cold month, I'd say, okay, maybe online spending would be higher, but actually it was lower. But I think that was just a function of the last, November and December was so strong. Over the last 3 months, if you average it out, online sales are running about 4% annualized pace, right? So I think January is always ripe for a bit of a pullback there, right? But then restaurant and bar sales, people are still going out. Over the last 3 months, restaurant and bar sales are running up about 9.5% annualized pace. It's just like, I'm laughing because it's a crazy high number, right? Even if you adjust for inflation, it's running just under 7% annualized over the last 3 months. Just in January, it was up 0.7%. That is really strong, right? So it confounds that weather story, but it just gets to, look, people have money, they're going out and spending.
No, I mean the sirens are going off. It's so it's so amazing.
Too.
It's Chicago. There you go. Chicago says
happening.
Hi. Yeah, something's happening on whatever day it is. Pretty sure it's Tuesday morning. But yeah, I mean, believe me, I think it was cold, and I hate to just use a cold excuse, but you look at some of those things, and I mean, you and I did a fun, playful Take 5 video where you were standing outside in Chicago, middle of January, and it was really, really cold. So, did you want to go to Lowe's or Home Depot to buy some building materials? I don't know. Maybe you wait a couple weeks, but but it's fascinating still that people are continuing to still go out and consume and go to bars and restaurants, and every restaurant that I seem to go to, I get to travel a lot. I mean, they're always packed. It just doesn't feel like too big of a recession there. Now, I will say our friends at Ned Davis Research pointed out that even looking at that 0.8% drop in January, they looked at all the average declines in January, and they didn't actually give the final number, but they just said if you look at all the average declines in January, that was still better. Okay, the 0.8 was still better than your average January decline going back to 1993. So just a little more context around sometimes. I mean, I think it's also, hey, everybody just spent a bunch of money for the holidays. Maybe you do pull back a little bit more. Maybe the economist's got to miss that. So again, it's just one data point, right? What Master Yoda say? One data point a trend does not make. We'll see if we see more weak data going forward. But that's kind of retail sales. Now, industrial production. This is a good one, too. You've been talking to some of the positives, but the high level, the headline industrial production was down 0.1%, expected to be up 0.2%, and manufacturing was down 0.5% month over month. Sonu, talk to us about why, again, that made sense looking back and why it's not a major concern going forward.
Right. So manufacturing is important. Now, how important is it for the U.S.? It's a lot less important than it is for Germany, South Korea, and China, right? But manufacturing is still important. It makes up about 12% thereabouts of the economy. It's, in terms of employment as well, it's like somewhere between 11 and 13%, right? That's how much employment. So it's not a big piece of the economy. It can lead sometimes it can tell you that, really cyclical areas of what really cyclical areas of the economy are doing, right? Going up, going down, all of that. But I would separate it. Like when you talk about manufacturing, why is manufacturing important for the country, right? Any country, it's because they pay well, typically, right? When you think about manufacturing of, machinery, high-tech equipment, semiconductor chips, vehicles, aerospace, all of that, right? They pay better. Now, what drove manufacturing production lower in January is actually non-durable goods, right? I'm not saying these are not important, but it was things like apparel, paper, chemicals, plastics, things like that. Durable goods production, which is where the real technical know-how, right, where really high-paying jobs in the manufacturing industry are, that rose, right? That was up 0.1%. Not a lot, but like I said, these are areas that are key for manufacturing know-how in the U.S., right? And what the good side is, here's 4 good stories, right, within that durable goods side of manufacturing. And I think manufacturing in the U.S., vehicle production is back, right? That was stagnant over the last few years. It's back to where it was before the pandemic. So I think that it's good from 2 ways, because that means there's more supply, and prices for new cars are also likely to come down because there's more supply. So I think that's a good story from an inflation perspective too. Then you talk about high-tech equipment production. You and I have talked about manufacturing, construction in the semiconductor space, all of that before. But then there's actual manufacturing of high-tech equipment that companies want, right? That was up 1.3% in January. So a big number there. It's up 20% year over year. Production of high-tech equipment, a lot of it is related to AI-related investment, CHIPS, IRA Act, all of that. That's up 32% since February 2020. That's massive for the U.S. economy, right? So you got vehicles, high-tech production. Then you talk about defense. Defense equipment production was up 1.7%, Ryan, in January. It's up 14% year over year, right? It's running about 10, 11% above where it was before the pandemic in December of 2019, right? And I think this is an area where government spending is boosting the economy. I would say good or bad. I think it's a good thing. Contrast that to what happened after the financial crisis, after 2010, right? Defense production actually went down for several years. It was a drag on the economy. We're not seeing that. That's a positive sign for the economy. So that's 3. Then aerospace production. This one I'm a little worried about, given what's happening at Boeing and the fact that they can't keep doors closed on their airplanes.
Yeah.
But production of aerospace and parts, right? This is another place where you have a lot of solid technical know-how in this country for that. And it's always good to see that increasing. That was up almost 3% in January, up about 12% year over year, right? Production's up, 10% above pre-pandemic levels. Again, good story. So I have like an asterisk there because of Boeing's issues, right? So hope, again, vehicles, high-tech production, defense, aerospace, 4 good stories. 4 very important stories, I think, with underneath the hood of what's happening in the economy.
No, I think that was great. I mean, that was wonderful. The only thing I had to add potentially there was just when you look at defense spending, it makes up about 3% of GDP. We've talked about this multiple times. I guess it was Neil, right? Neil Dutta first pointed this out kind of to us, put it on our radar that's historically low. When you look around the world, look around the globe, what's happening, that's probably going to go higher, right, going forward. And now we're actually seeing the hard data that does suggest that can go higher. And we've talked before. They're going to use the F word if that's okay. Fiscal policy. Fiscal policy doesn't have to be a bad thing, right? I mean, the onshoring and bringing things back, building these incredible technologies and major facilities to do AI and chips and different things, high technology. It's been soaring, and you've been talking about it, Sonu, honestly, for well over a year now. And those are things that we don't always hear about. When you talk about what's going on out there, what's something you don't hear about so often when you turn TV on. Well, I think it's those. Those are some of the major developments, and then we're not even seeing the fruits of that labor, is the way I like to put it. The surge in productivity that should come from these things. We're just building these big factories now, but we're going to start to see the benefits of that over the coming years and hopefully even decades, if you think about it. All right. So Sonu, we're going to hit the end of the road. That was a great discussion. I guess again, let me do this first here. Let me find it. Here we go. So again, this is episode 73 of Carson's Facts versus Feelings with Ryan and Sonu. Again, we title it, Did the Economy Actually Slow Down? Sonu, answer it. Did the economy actually slow down? What do you think?
Look, slowing down, it would be one thing if it slowed down. Last year, we grew at 3.1%, right? Year over year GDP growth after adjusting for inflation. That's hot, right? Is it great? Is it really hot? No, it's not too hot, right? But it's above what we saw between 2010 and 2019 when economic growth after adjusting for inflation averaged about 2.5%. So we're well above that. A slowdown right now, I'll underline it this way, right? After accounting for this retail sales number, industrial production, all of that, the Atlanta Fed GDP now, which makes a forecast for every quarter GDP right now, Q1 GDP is running at 2.9%. That's still above trend. Yes,
bad.
it's slowed down from 3.1% to 2.9 maybe, but we're still above trend. And I think, if you ask me how fast do you think the economy is growing, I would look at, okay, tell me how fast incomes are growing in the economy. Right now, incomes are growing about, in real terms, after adjusting for inflation, between 2.5% and 3%. I would say that's the pace of economic growth, underlying pace of economic growth. And that's pretty solid. That's, I think, slightly at or slightly above the pre-pandemic trend.
No, absolutely. Well said there. So with all that, everyone, I think we're going to wrap up this week's Facts versus Feelings. And I was thinking of this. I don't know, Chelsea, can you send me the lingo, how to say, or is it there?
Yeah.
Maybe it's there. Oh, here it is. All right, let me read this. Here we go. Thanks to Chelsea, our producer.
There you go.
Help us out by telling us how we're doing. Leave a review, give a like, and subscribe if you want to hear the latest. And then I definitely want to promote Leap Day coming up. Maybe should have done this in the middle. I kind of forgot, but we'll do it now. We've talked a lot about this on Leap Day. We're having a live stream, Facts versus Feelings, for 4 hours, starting at 10 o'clock Central Time, 11 o'clock Eastern Time. Top of the hour, we're having multiple guests. Let's see. Hopefully I know this by now. Dan Ives is first, right? Then Kathy Wood is second. And who's third?
Libby Cantrell.
Libby Cantrell over at PIMCO does amazing work from a policy point of view. Then we're going to finish things off last but not least with Neil Dutta at RenMac, one of the greatest, one of the best economists, macro thinkers out there. And then, of course, the first two we just talked about with Dan Ives and Kathy. I mean, you guys know what they do. They're all over the place, thinking about the world from a tech point of view, AI, Bitcoin, all the stuff that combines it all. And Sonu, how can people sign up for that, or how can they watch it? Do you want to let them know?
It's going to be live streamed on LinkedIn and X/Twitter. And we have if you go to Ryan's page or my page on X or even LinkedIn, you'll find the link to that, the link to the LinkedIn page where you can sign up, set a reminder, all of that. And definitely sign up. I'm so pumped about Leap Day. It's coming up in 9 days.
It's going to be very, very soon here, I guess. You get one extra day a year. How are you going to spend it? Spend it with us. And you can actually go to carsongroup.com/leapday. That'll take you to the LinkedIn page you can sign up for. But hopefully just set a reminder on your phone, wherever our social media, Carson social media, Sonu social media, you can find that. It's going to be a fun day. And we'll still do our regular, just because I know somebody cares out there. Some listeners like, well, are you still going to do your regular? Yes. We will. We just discussed that. We will still do a regular podcast, which should come out on Wednesday. Again, that's before Leap, whatever that Wednesday. I guess it's 28th. I guess
28th.
Yeah, 28th. 28th. Yeah, so the 28th, and then on Wednesday, the 29th, we'll have 4 hours of fun. So with all that, everyone, thank you for listening. Sonu, thanks for a great discussion as always, and happy anniversary of being a U.S. citizen. That's awesome. And with all that, everybody, we'll see you next week. Let's keep it rolling. We'll see you then. Take care. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.